Welcome back to Morning Trade Live. We've got an interesting session so far here. The Russell's up as bond yields are down, but tech's having trouble with those Salesforce earnings and more. Joining us, Liz Ann Sonders is going to put the pieces together, Chief Investment Strategist at Charles Schwab. We got a lot to talk about this morning, Liz Ann. Good to see you.
Yep. Nice to see you too, Oliver.
So let's start kind of with the macro. It seems like we're still sensitive to big moves in bonds the past week, but once again, we see there are certain areas that are the most sensitive. How do we know if the rate situation is going to be a problem for the broad market?
I think for the larger cap indexes, let's use the S&P as an example, there is still a negative correlation between the 10-year yield and the S&P. However, you get to a much larger negative correlation when you go down the cap spectrum, when you look at indexes like the Russell 2000. So I think there's shorter term, greater sensitivity down the cap spectrum to moves in the 10-year. That said, the higher for longer thesis, we have already started to see a hookup in the percent of debt represented by interest expense, even for the S&P 500. So I think that's where it ultimately comes into play as it relates to margins and the earnings outlook going forward.
When you look at the earnings of big tech, as we kind of shift into the software side, it seems like things get a little weaker. It seems like the further we move out from the epicenter, basically, of NVIDIA, we're getting a little thin.
Well, not only that, but if you look at the Magnificent Seven, the peak in that collection of stocks earnings growth was between the third and fourth quarter of last year, where you had earnings growth of more than 60%. It was at a time when overall S&P earnings growth was low single digit. But based on consensus expectations, by the time we get to the third quarter of this year, there will have been a convergence where you see the Magnificent Seven earnings in the kind of 15% range, but overall S&P will have caught up and seen the acceleration. So I'm not sure how much of that is in the numbers. What's also interesting, you mentioned NVIDIA. In the aftermath of their earnings, the stock was up more than 20%, yet the overall S&P was actually slightly down. So it's obviously still an important stock, but there's a lot of churn and underlying weakness going on in the index. And it's no longer the case that a single stock can be supportive, even if it has a huge run.
You describe it as the split market. It's a pretty good way to do it. Equal weight got dinged pretty hard this past week, never put in a new high, while the market cap weighted index did. How much does that market cap skew overlap with quality, Liz Ann? Have we seen some softness creep into that reliable quality trade too?
I think the sort of trade, if you want to call it that, where leadership has resided, it can be thought of, yes, I guess still with the wrapper of quality, but the grouping of factors that have been working somewhat consistently. You could almost harken back to the days of the popularity of GARP, growth at a reasonable price, because you have that growth component to factors that are working, but there needs to be that value component too. So it's a slight shift in how we're thinking about factors and where leadership is going to reside. It needs to have that blend of both strong growth factors, but you need to also be mindful of the value side of the equation.
Okay. The value stuff, the kind of deeper value, is a lot of that dependent on rates when you look at companies that have debt coming up or need a little help? I mean, if we're not going to get those cuts before the election, should there be some real financial stress expected?
Down the cap spectrum, absolutely. And that's where factors like interest coverage come into play, but also the profitability backdrop. If you're, a zombie company, meaning you have negative earnings, you don't have enough cash flow to pay interest on debt, and you've got a maturity schedule that suggests your debt costs are going up, that's where the real pain points are going to be, versus, of course, the larger companies, not exclusively, but the larger companies in many cases have enough cash that they're earning more interest on their cash and they're paying interest on debt. So given the split market, as you talked about, by the way, let's put some numbers on that. If you look at the overall Russell 1000, so obviously a broader index than just the S&P 500, you've got about 45% of stocks that are in the red on a year-to-date basis. You also have about a third of stocks that are up at least as much as the overall S&P 500, so up at least 10%, if not, I think it's 16 or 17% are up more than 20%. So that's the split market. That's, Hindenburg Omen kind of stuff where you've got a rising share that are both very weak profiles, 52-week average kind of profiles, and strength. And that is another way of looking at sort of this churn under the surface, which is why in an index, and we've talked about this, Oliver, like the NASDAQ has had no more than a 9% drawdown this year from its peak to the worst point at its trough. But the average member within the NASDAQ on average has had a 35% drawdown.
That's such a crazy stat.
That's serious churn under the surface that is just masked by the virtue of larger cap names still dominating these cap weighted indexes.
I mean, it's more extreme than really any other time, right? I mean, I'm just kind of guessing. I don't know I don't have the charts in front of me, but because you hear people for a long time that would kind of colloquially describe the market as being so dependent on big tech. But a few of those moments over the last decade, it wasn't quite true. There were moments where, yeah, these stocks are doing great, but, there's breadth otherwise. I mean, this really is is it unprecedented? Can we call it that?
Well, you had periods in the late 1990s, and the problem is for an index like the NASDAQ, most of the robust data only starts at about 2001. So to look at things like the average member maximum drawdown in the late 1990s, the data isn't robust enough to be able to access that. But anecdotally, we clearly had a very concentrated market in the late 1990s, whether you look at the weight of the top 5 stocks or the weight of the top 10 stocks, and you had a lot of underlying weakness, especially in the more sort of value areas when we were in that, the final stage of the tech bubble. So I don't think it's unprecedented, but certainly if you're looking over a period of, say, 10 years, this is very unique. And I think it's just important to understand. Everybody would probably choose to have corrections via rotation under the surface as opposed to, the NASDAQ drops by 35% all at once. But it is a better reflection. It's sort of the more accurate story that the market is telling is being told underneath the surface of just what the index level gains or losses are showing.
Okay, great stuff, great stats. And yeah, that was the kind of post-GFC period is what I was wondering. So for the NASDAQ, is it the median or the average drawdown? Just to give me that stat again, that's 35%?
Yeah, so 9% at the index level is your maximum drawdown year to date. But the average member within the NASDAQ has had a 35% average drawdown.
Okay.
And that's also year to date.
And
I post a table on my Twitter X feed every morning that has those stats in it. So take a look.
Oh, perfect. Great. All right, let's talk some of the economic data from this morning. GDP, like a tad lower than what some of the estimates were, but it's still a pretty good pickup over the last couple months.
Lower, but the consumption piece of it was revised down fairly significantly, and unfortunately, although PCE, the consumption weight was revised lower, the price index, which was also revised lower, was only revised lower by 1/10, and is still on an accelerating path, and that provided some discomfort. If you look in general, though, at GDP post these revisions today, you still have a story of weakness being driven more on the trade side of things, the net import versus exports and inventories, the final sales to domestic purchasers, which is that true domestic component that X's out the impact of imports relative to exports, as well as the inventory piece, still looks fairly decent. And of course, you've got nowcasts like Atlanta Fed GDP now that still is tracking at a pretty decent rate for the current quarter. So certainly not falling apart, but I think that downward revision on the consumption side is worth watching given everything that we're all focused on now with regard to the consumer.
Okay. So the overall trajectory here, I mean, we've seen some kind of cracks form, but it seems like generally they're not big cracks in the economy. We're holding in. It kind of seems like we're in that status quo still, because there were a couple bad weeks there from April to May, mostly survey data, but it was pretty alarming how bad some of those survey data were. So can we say
Well,
the hard data's held in?
But I would also say, though, there was also some good survey data. S&P Global's version of the PMIs surprised on the upside, both for manufacturing and services. And if you remember, that was a really, when those printed, that was a really weak market day. So that was an example of good news isn't necessarily good news from the perspective of the market as it relates to Fed policy. So the upcoming in the next week, we've got both ISM services and manufacturing. I think those are really important. They're more widely watched in the S&P Global version, but to see whether it corroborates that pickup in growth that was seen in those PMIs. And then, of course, next week's jobs report. We're in this environment of data dependency on the part of the Fed, which means we're all at the mercy of the data, and the needle can move really, really dramatically in terms of market reaction, expectations around Fed policy, the start point, how many cuts are expected. But I think when I think about the numbers that are important over the next week, the ISMs and the jobs report are paramount among them.
How about inflation tomorrow, just to kind of get us ready? What's the baseline, and is there a potential for surprise there? What do you think, Liz Ann?
There's not as much potential for a surprise with PCE, only because the data that you get in CPI and PPI can be mapped to PCE. It's not an easy exercise to do. There are economists that attempt to do it. So you don't tend to get a big surprise either above the consensus or below the consensus for PCE, but it could reinforce that we're not in this deceleration trend. We have to remember the math is not terribly favorable right now, because we're coming up against what was last year's April to August period, where the month-over-month readings were descending quite dramatically because the year-over-year was going up against the prior year, which is when you had a 9 handle on CPI. So those easy comparisons a year ago now turn into much more difficult comparisons. And even if you track core PCE on a month-over-month basis at what it's been doing for the last several months, for the rest of this year, the hook back up in core inflation is going to continue, meaning you'd have to have a significant downside surprise in month-over-month readings to get that metric anywhere near the Fed's target of 2%.
Okay. All right. Good real talk. Great stuff, Liz Ann. Thank you very much for your time.
My pleasure. Good to see you.
All right. Great stuff. Liz Ann Sonders, Chief Investment Strategist here at Charles Schwab.